In this episode, I'm going to show you how to build a dividend stock portfolio that is going to be safe, reliable, and provide you with consistently growing dividend income. I'm also going to show you some extraordinary returns that you can achieve with dividend stocks, and we'll take a look at how many dividend stocks you should own in your portfolio. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following three topics. We'll start off with our approach to dividend investing. Then we're going to take a look at what to invest in. And then we'll take a look at building your portfolio. How many stocks should you own in your portfolio? And what does a typical dividend portfolio look like? So let's get started with our very first topic, our approach to investing. And our approach is to help you build a resilient portfolio that generates growing income for you each year. Now, the key words here are resilient, which means regardless of what happens in the stock market, stock prices go up and down all the time, the portfolio should continue to provide you with growing passive income each year. So let's take a look at a real quick example, a real life example of what is involved when we talk about building a resilient portfolio and when we talk about growing passive income. So quick example, we're going to take a look at Colgate-Palmolive. This is an American company, and we're going to take a look at the last 30 years of Colgate-Palmolive. You can see here on the screen in front of you the stock price for the last 30 years, and the stock price, as I said before, goes up and down all the time. And we can see in some cases the stock price dips by more than $5, $10 a share, but overall in the last 30 years, the trend has been going up. So that's pretty good. So that shows you the resiliency of this stock over the last 30 years. Even though there are ups and downs, over the long term, we can see that the stock has done quite well over the last 30 years. Now we want to take a quick peek at passive income, which is the dividend that comes to you as a shareholder. And so does the dividend grow every year, in this case with Colgate-Palmolive, or does it go down? So now you can see the same graph, but we've now overlaid on top of it an orange line, and that represents the dividend over the last 30 years. And you can see that the dividend has gone up every year consistently. And even though the stock price goes up and down, even though the stock price drops by more than $10, $15, $20 a share, the dividend keeps going up year after year. And that's because the dividend is not paid from the share price, but it is paid from the earnings per share, or the profits. So as long as the company is profitable over the long term, it can continue to pay you a dividend and continue to increase that dividend year after year. In fact, Colgate-Palmolive has had 62 years of consecutive dividend increases, which is incredible. Think about how many market crashes we've had in the last 62 years, how many market downturns we've had. But this company here has continued to not only pay a dividend, but to increase it year after year after year. And that dividend, every time it goes up, it's more money in your pocket. And that is your passive income that you receive just for owning these shares. So now let's move on to our second topic in today's episode, and that is what exactly should you invest in? Because we're talking about building a portfolio, so you need to know what to invest in to create that portfolio for yourself. Now, keep in mind there are over 7,000 securities that trade in the US and in Canada today. And that includes common stocks, mutual funds, index funds, ETFs. So there's a lot of choice out there, and I know it can get very confusing. And when you think about 7,000 securities trading in the US and in Canada, it can feel overwhelming, right? So how do you even decide what to invest in? So we're going to cover that right now. So what I'm going to give you are 12 simple rules. And these are essentially, these rules make up your checklist. So you want to make sure that any company that you invest in passes all of these 12 rules. It has to pass everything on the checklist. If it fails even one rule, you skip it, move on to something else. These 12 rules are designed to minimize your risk and maximize your gains. We want to keep investing as simple as possible. We want to build a long-term resilient portfolio for you, and we want to make sure that that portfolio provides you with growing passive income each year. So the 12 simple rules are designed to help you achieve all of that. So let's take a look at rule number 1. Do you understand a product or service offered by the company? If you don't, skip it, move on to something else. Now, this doesn't mean that you have to spend hours and hours researching the company. You don't need to be an expert at it. You just have to have a general idea of how the company is making money. So if we take a look at Coca-Cola, for example, everybody recognizes this brand. You know how the company is making money. They are a beverage in the beverage industry, so they sell soft drinks, bottled water, juices, and that's how they make money. Let's take a look at rule number 2. Will people still be using this product or service in 20 years? Because you're investing your hard-earned money into any of these stocks that we're talking about, dividend stocks, you want to make sure that the company is going to be around for a very long time. So we want to stay away from fads or short-term products or services that nobody's going to need, 20 years from now. But when we think about banking services, insurance, mortgage, utilities, food, these are things that people will still need for many, 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 many years. Let's take a look at rule number 3. Does the company have a low-cost competitive advantage? So the best way to explain rule number 3 is to use Warren Buffett's example, and that is, think about a company as a castle. The corporation is a castle. And around that castle, the larger the moat, the deeper it is, the wider it is, it's going to do a better job at keeping its competitors out. And so when we think about companies, we want to think about a corporation that has a very large moat around it. How well does the company keep competitors out of its space? So a good example is McDonald's. They operate in over 100 countries. They've been around for a very long time. And if you are looking for a Big Mac, there is only one company in the world that can give you that. Sure, there's other competitors out there, but McDonald's has such brand loyalty and brand recognition that they make it very difficult for competitors to enter that space. And if you really want a Big Mac, you will cross the street to the nearest McDonald's and get that, even though there might be other restaurants right next to you. So McDonald's, Coca-Cola, these are good examples of companies that have very large moats around them. Let's take a look at rule number 4. Is the company recession-proof? So think about this for a second. If there's a chance that you may lose your job or we're in the middle of a recession, are you going to go out and buy a brand new car? Of course not. You're going to keep the one you have, or you might look at public transportation or other ways of getting around. So just for that reason alone, we don't invest in car companies. Same thing with air travel. If there's a recession or there's a chance you may lose your job, you're not going to go on an expensive trip overseas. So we don't invest in airlines either. So rule number 4 is to make sure that we invest in companies that are going to provide product and services even if there's a recession, right? So even if you lose your job, you still have to eat. You still need a place to live. You're still going to brush your teeth every morning. So these are things that you will need products and services. So we want to invest in those companies so that even if there is a recession, our portfolio is not going to drop drastically. Rule number 5. is the company profitable? We want to make sure that we're selecting companies and stocks that are profitable, that have a history of profitability. So rule number 5 is in 2 parts. So 5A, we're going to take a look at the 20-year average earnings growth, EPS growth, and it must be 8% or more. If it's not, we skip it, move on to something else. And 5B, we want to make sure that the EPS, earnings per share, must have increased at least 8 times in the last 20 years. So we want to see at least 8 increases in the last 20 years. If not, the company will fail rule number 5 and we move on to something else. Perfect example are these 2 graphs that you see on the screen here. The graph at the very top is showing earnings per share. So is the one at the bottom, but the one at the top, the earnings go up, then they go down, then the company has negative earnings, then they go up again, then there's negative earnings, and goes up and down. It's completely random. When I look at the graph at the top, I have no confidence. Is the company going to be profitable next year or not? However, when I look at the graph at the bottom, you can see that there is a consistent trend upwards. And if we look back at the last 20 years and we see a graph like this, this will give us confidence that the company will hopefully keep its earnings positive and grow the earnings in the future. Now let's take a look at rule number 6. Similarly, the way we were looking at earnings per share, we're now looking at the dividends. So we want to make sure that the 20-year average dividend growth is at least 8% or more. If it's not, the company's going to fail rule number 6, and then we will move on to something else. Now, what is a dividend? So those of you who've been watching my episodes in the past will already know the answer. Those of you that are new to the channel, I just want to take a minute just to talk about dividends. We've already talked about them at the start of this episode. So what is a dividend? A dividend is basically the company sharing its profits with you, the shareholder. So in this example, if a company is paying a dividend of $1 per share and you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. That money gets deposited directly into your trading account as cash. So you can spend the money if you wish, or you can reinvest it. Now, it's important to note, and we showed this earlier with the example of Colgate-Palmolive, even if the share price tanks, even if there's a market crash or a market recession, we will see that there are companies out there that will continue to not only pay the dividend to the shareholders, but also grow the dividend as well. And every time the company increases the dividend, that is more money in your pocket. So that's why rule number 6 is important. All of the rules are important, but as dividend investors, especially for us, we want to make sure that the dividend growth is there, that there's a solid track record of dividend growth. And so same thing with the graph, right? Similar graphs that I showed you before. The graph at the top shows the dividend going up and down, the dividend's getting cut, dividend's getting eliminated, then they pay a dividend, then they reduce it again. It's completely random. We have no confidence in this company's ability to continue to pay a dividend to us. However, the graph at the bottom is consistent, it's reliable. You can see that the trend is upwards. The company is growing its dividend. And we saw that with Colgate-Palmolive as well. When I showed you the 30-year graph, you could see that the dividend had gone up every single year. Rule number 7, we want to make sure that the payout ratio is 75% or less. So what is the payout ratio? It's basically the dividend, the annual dividend, divided by the earnings per share. Let's take a look at company A. Quick example. The company has earnings per share of $4. Okay, so you can see that up on the screen. That's how much money they made, their profits of $4 per share. And the company is paying a dividend of $1 per share to the shareholders. So if we take 1 divided by 4, we express it as a percentage, that's 25%. So 25% of what the company earned, they paid back to the shareholders. The rest of the money, the company reinvested into itself to grow the business. So this is a healthy payout ratio of 25%. Now let's take a look at company B. The company earned $1 per share, the earnings per share, but it paid a dividend of $2 per share. So the payout ratio is 200% here. How could a company that only made $1 per share pay a dividend of $2 per share? Well, in this case, they probably had to borrow money from somebody or someplace to be able to pay the shareholders. And so this is an early warning sign that the dividend could be at risk. The company's either going to have to cut the dividend or increase their earnings per share dramatically. So all things considered equal, company A is going to be a better investment in this case. Now let's take a look at rule number 8. We want to make sure that the company's debt is 70% or less. So a quick example, if we're looking at company A has a debt of 5%, company B has a debt of 800%. Again, all things considered equal, company A is going to be a better investment. Why? Because company B is carrying around too much debt. And when interest rates go up, company B is going to have a very hard time paying off its debt. The interest payments alone are going to be very high. And if we end up with a market downturn or a market recession, company B is going to have a very hard time surviving that market recession. So it's important to look at the debt, and we want to stick with companies that have low debt because it's a good indication of their financial health. Rule number 9, has there been a recent dividend cut? If so, we want to avoid any company with a recent dividend cut. And as of this recording, there's been 2 major dividend cuts in the news. And one of them is Walgreens. They recently cut their dividend, reduced it by 48%. So they didn't eliminate it, but they reduced it by 48%. And same thing with 3M. They reduced the dividend by 54%. So those are very big cuts in the dividend. And as dividend investors, that's not a good sign for us. So if you don't own Walgreens or 3M, then according to rule number 9, you should avoid both of those companies for now until we have to wait for some time and to see what happens with the dividend next year. At this point, the risk is just going to be simply too high. If you already own Walgreens and you own 3M, well, there are, I've made a couple of previous episodes where I talk about what to do in that case. So that's covered in those previous episodes. Okay, let's move on to rule number 10. Does the company actively buy back its shares? If not, we skip it, we move on to something else. Rule number 11. Is the stock priced low? So remember I said stock prices go up and down all the time. We want to make sure that we're investing in a company when the stock is priced low, when it's undervalued. Doesn't mean it's a bad company. It just means that the stock price has come down where it's undervalued versus overpriced, where it's too high in price. So rule number 11 is broken down into 3 parts. So rule number A is to look at the PE ratio, which is the share price divided by the earnings per share. So let's take a look at company A. Let's say the share price is $30 today and the earnings per share is $4. So 32 divided by 4 is 8. So this company A has a PE ratio, a price to earnings ratio of 8. Basically what this means is that for each share, you are paying 8 times what the company earned. So the company earned $4 a share. Well, the share price, multiply that by 8, is $32 a share. So that's what you're paying to buy a single share in this company. Let's take a look at company B. Company B also has the same earnings per share of $4. However, its share price is $380 a share. So you can see the PE ratio is 95. So all things considered equal, company A is going to be a better investment because it's priced low. Company B, you are paying 95 times what the company earned for a single share. So that's going to be too high. So that was rule number 11A, which is the PE ratio must be 25 or less. Now we're going to take a look at rule B, which is the current dividend yield must be greater than the company's 20-year average dividend yield. So for more information on that, how we figure out that formula, how to figure out the average dividend yield, I'm going to suggest that you go back and watch episode 1, because that's where we cover in detail rule number 11B, how to figure out if a company is priced low or if it's priced high. So let's move on to rule number 11C. The PB ratio must be 3 or less, and the PB ratio is the price to book value, so it's the share price divided by the book value per share. So in this example, take a look at company A. The share price is $32. The book value is $16. The book value is essentially, think about a company, if it was to liquidate everything today, everything the company owns, so that would be the office buildings, the factories, machinery, delivery trucks if they have any, computers, desks, everything that they own, you would sell it off, pay off all the debts, and you'd be left with the book value, right? So that is the book value of a company. So in this example, company A has a book value of 16, share price is 32. So if we take 32 divided by 16, you can see the PB ratio, the price to book ratio is it's 2. So now let's take a look at company B. Company B has the same book value, 16, but the share price is 380. So you can see that the company B, the PB ratio is 23.75. So again, all things considered equal, company A is going to be a better investment because the share price is trading closer to the company's book value versus what's happening with company B, where the share price is too high. So rule number 12, keep your emotions out of investing. The key to successful investing is patience and discipline. So the patience to ride out any market downturns, because they will happen every couple of years. We have a market downturn, stock prices come down, so you got to have the patience to ride those out, and the discipline to stick with the 12 simple rules that I've showed you today. There's no exceptions. We don't skip any of the rules. We stick with the 12 rules, and you end up with quality dividend stocks. What I don't want you to do is to do this, and you can see it up on the screen here. When the stock market is going up, 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 and up, people get greedy and they start buying more and more and more and more. Not just stocks, but even mutual funds, index funds, ETFs. And what you're doing there is you're buying everything at a very high price. And remember, we talked about overvalued and undervalued. So we don't want to be buying at a high price. And then when the market tanks, people panic and they start selling. So we don't want to do that. The best time to buy is when prices are low, because you can get the stocks for less price. And because the stock price is less, the dividend yield is going to be higher, right? Because you can, if the price of the stock is less, you're going to be able to buy more shares for the same amount of money that you're investing. And remember, the dividends are paid not based on the share price, but based on the number of shares you own. So the more shares you can buy, the more money you can receive in dividends. So remember, don't do this. Keep your emotions out of investing. Patience and discipline are key. Now, some of you might be thinking, what about mutual funds, index funds, and ETFs instead of individual stocks? So just a couple of notes here. With any mutual funds, index funds, or ETFs, you're buying a basket of stocks. You're not buying just one stock. It is a collection. Some of these index funds have hundreds, if not thousands, of stocks. Some of the index funds own other index funds. Same thing with ETFs. They'll own other funds inside of them. So now you own thousands and thousands of stocks. What's going to happen is you are inadvertently going to be buying companies that have very high debt, that have a very high payout ratio, where you're going to buy them where the PE is too high and the price is overvalued. Not every stock in an index fund is going to pass all of the 12 rules of simply investing. So if you wouldn't buy a stock individually because the debt is too high, then why would you buy it inside of an index fund or an ETF or a mutual fund? Right? So then the other problem is too much diversification. Like I said, thousands and thousands of stocks in there. So for that, I recommend going back to watch episode 44, and we cover the issues of too much diversification. And then, of course, all of the funds, index funds, ETFs, mutual funds, even if they're allowing you to buy them with zero commissions, buy and sell, all of these investments, index funds, ETF, mutual funds, they all carry fees. There's an MER, a management expense ratio. Even when the MER seems low, 0.05% or 0.4%, the numbers seem very low, the fees will add up over time. And so for that, I recommend you go back and watch episode 38, where we cover in detail the impact of those fees on your investments. Okay, let's move on to our last topic in this episode, building your portfolio. So the key thing here is to remember is don't put all your eggs in one basket, which means do not buy all of your stocks in the same sector or the same industry. Over time, you want to make sure that you are well diversified, and you can see the list of sectors up on the screen here. You want to make sure that you're investing in companies from these different sectors. So we have energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. So this is not going to happen overnight. It takes years, usually around 3 to 4 years, to build a well-diversified portfolio across all of the sectors that I've just listed. And so why do you want to diversify your portfolio? The answer is simple, is to reduce your risk. Because if you put all your eggs in one basket, if all of your money or the majority of your money is in, let's say, the energy sector, and all of a sudden the energy sector drops or tanks, there's a recession or a market downturn, or just that sector is impacted, well, then your entire portfolio is going to be down. So in order to minimize your risk, we want to make sure that you're well diversified. And then the other question I get a lot is, how many companies should you own in your portfolio? And so that's going to depend on the amount of money you're investing, your time horizon, and how much time you have to monitor your investments. So the answer is going to be on average anywhere between 25 to 50. I know there's some investors that like to stick with 25 stocks, some even less than that, and then some that have 50 or more than that, but on average between 25 to 50. It'll be easy to manage, you can keep track of them, and you're not going overboard with too much diversification. Now, if you own a large number of stocks, like a couple of hundred stocks or 200 stocks, it will eventually become unmanageable to keep track of everything and just to manage all of the large number of holdings. And then your returns will be affected as well, since there's a higher probability for you to own non-quality stocks. And we talked about that before with index funds, ETFs, and mutual funds. So remember, you are investing for the long term. 5, 10, 15, 20, 30, 40 years. The longer the better. Because that way you can ride out any market downturns. And let's finish off this topic here, this episode today, with the other question is, what do the returns look like? And so I'm going to recommend that you go back and watch episode 7, where we talk about extraordinary returns with dividend stocks. Now, keep in mind, those are extraordinary returns. Your returns may not be the same, but even if you were to earn a fraction of that, you would do very well for yourself. So I'm going to give you just 2 quick examples from episode 7. So one was with Coca-Cola and the other one was with Walmart. Again, episode 7 has all the details, how many shares, when they were purchased, how long they were held for. Here I'm just going to give you the highlight. So in episode 7, we show you how a $4,600 investment in Coca-Cola would be worth over $7 million today. And even better, that investment today would provide you with over $200,000 a year in dividends. In Walmart, if you started with an investment of $1,650 over many decades, today it would be worth over $29 million. And that investment alone would be providing you with over $458,000 a year in passive dividend income. And all you had to do in both of these examples was to purchase those shares and just hold on to them. There was no buying or selling, no frequent trading. It was just to buy and hold. And so that's the reminder again, is that we are investing for the long term, and the dividends are the return on your investment while you hold on to the shares. Stock pricing can go up and down. You don't need to be worried about the stock prices as long as the dividends are coming in, as long as the dividends are growing every year. So remember, our approach to investing, like I said at the beginning of the episode, is to invest in quality, dividend-paying stocks when they are priced low. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock, and how do you know if it's priced low? Well, for that, we apply the 12 rules of simply investing. And so we've covered them in today's episode, so I'm not going to go over them again. You can see the 12 rules up on the screen. If anybody is interested, I do have the Simply Investing course. It's an online self-paced course with video modules. In module 1, we show you the investing basics. Module 2, I cover the 12 rules of simply investing with you. Module 3, you learn how to apply the 12 rules. Module 4, you learn how to use a Simply Investing platform. Module 5, I show you how to place your first stock order step by step. Module 6, you learn how to build and track your portfolio. Module 7, when to sell, which is just as important as to knowing when to buy. Module 8, how to reduce your fees and risk, especially when it comes to index funds and ETFs and mutual funds. Module 9, your action plan for getting started right away. And Module 10, answering your most frequently asked questions. So we cover that in Module 10, and so that is the Simply Investing course. If anyone is interested, we also have the Simply Investing platform, which tracks over 6,000 common stocks in the US and Canada every single day, and it applies the rules to all 6,000 stocks every single day. So you can log into the platform, quickly figure out what to avoid and what to consider. So if you're interested in the course or the platform, we have a coupon code for you, so you can write this down, SAVE10, SAVE10. This is going to save you 10% off of the course and the platform as well. If you enjoyed today's episode, be sure to hit the subscribe button. We have a new episode out every week. Hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.